Welcome to Tech Money Madness, your daily U.S. stock market podcast, August 18th, 2026.
Glad to be here.
So, if you have been looking at your portfolio over the last month and wondering why the rules of gravity seem to have completely changed, I mean, you are definitely not alone.
Yeah, definitely not.
Because today we are doing a deep dive into a massive stack of economic research, market analyses, and policy briefings. And they all point to this really bizarre reality where, the boring 130-year-old sugar water company, Coca-Cola, is suddenly beating the absolute smartest AI chip companies on Earth.
Which is wild to actually see happening in real time.
It is. So our mission for today's deep dive is to unpack these sources, figure out why this is happening, and explain what it actually means for your money. Because for 4 straight years, the playbook was just so simple.
Oh, incredibly simple. Just buy mega cap growth.
Exactly. You bought mega cap growth, you watched the S&P 500 ETF soar, and you basically ignored everything else. But according to the data we're parsing today, that massive concentration is officially unwinding.
It really is.
We're seeing capital just rushing away from high multiple tech and flooding into defensive value-oriented positions.
Yeah. I mean, it's a structural earthquake. That's the only way to describe it.
Yeah.
The engine of your portfolio is actively shifting gears. And if you want to understand where the smart money is flowing right now, you really have to look past just the daily ticker tape.
Right. Look at the underlying currents.
Exactly. The sources we brought to the table today, they paint a picture of a market where corporate earnings are only half the story. The other half is this brutal tug of war involving the cost of capital, a really fracturing geopolitical landscape, and honestly, a fundamental redefinition of what a safe investment actually looks like in 2026.
Well, let's start with that cost of capital.
Right.
Because every single article in our stack points back to the core engine of anxiety for investors right now, which is inflation and the Federal Reserve.
Always comes back to the Fed.
Always. But see, I'm looking at the July data, and on the surface, it seems totally benign.
Yeah.
Like the Consumer Price Index, the CPI, came in at a pretty modest 0.1% for the month.
Yep.
Which puts the annual rate at 3.4%. But more importantly, the Producer Price Index, the PPI, which measures wholesale prices, that was completely flat.
Completely flat.
Right. It actually missed the 0.2% consensus forecast.
Yeah.
Plus, those alternative trimmed main measures, which strip out the most extreme price swings, they're sitting at multi-year lows.
They are.
So help me understand this. Because if the surface of the water is this calm, why do our sources indicate Wall Street is absolutely convinced a rate hike is on the horizon?
Well, because Wall Street is looking at the riptide pulling underneath that calm surface.
The riptide.
Okay. Yeah, I mean, the headline numbers look muted, sure, but the underlying structural costs are flashing some pretty massive warning signs. The research actually highlights 2 hidden currents here.
Okay, what's the first one?
First, import prices from China just hit their highest level since 2008.
Wow, 2008.
Yeah. So the U.S. is actively importing inflation from abroad. But the second current is even more fascinating, I think. It's the AI infrastructure build-out.
Okay, wait, let me challenge that for a second.
Go for it.
Because the entire pitch for artificial intelligence over the last, 3 years, was that it was going to make corporations wildly efficient.
Right.
Like it was going to automate massive workloads and fundamentally drive costs down. Are sources saying that was just wrong?
Well, not wrong, just early.
Early.
Yeah, in the long term, that deflationary efficiency is still the promise. But right now, the mechanism of actually getting there is violently inflationary.
Because of all the physical stuff you have to build.
Exactly. Building the physical infrastructure for AI is incredibly resource intensive. Think about what goes into a massive data center.
Yeah.
You need millions of miles of raw copper for wiring, industrial scale cooling systems, massive power grid upgrades, and, highly specialized labor to put it all together. The sheer physical footprint of this technological revolution is driving up commodity and construction costs across the board. Furthermore, the corporate adoption of the actual AI software has been a lot slower than anticipated.
Oh, interesting. So they're paying for the shiny new toys, but not using them yet.
Essentially, yeah. Companies are paying these massive upfront costs for the physical infrastructure, but they aren't reaping the software efficiency benefits yet to offset it.
So in a weird twist of fate, the technological cure for economic inefficiency is actually the thing causing the inflammation today.
That is exactly it. It makes a lot of sense when you break it down like that.
It really does.
And, the research shows central banks are very aware of this dynamic. Fed Chair Kevin Warsh's recent rhetoric heavily emphasized that, quote, Inflation is a choice.
Inflation is a choice. That's a pretty strong phrase.
It is. That is direct central bank code signaling a willingness to hike rates to kill these underlying pressures.
Wow.
And this isn't just a U.S. anxiety either, it's global. Look at the briefing we have on Singapore.
Oh, yeah, the monetary authority there.
Right. The Monetary Authority of Singapore just executed a surprise tightening move.
Wait, a surprise move?
Yeah, because rising oil prices are rekindling their own domestic inflation risks. Central bankers globally simply do not believe the inflation beast is dead.
Which means the Fed has to keep administering the medicine of tight monetary policy. But I guess that brings us to the casualties of that war, right?
Always casualties.
Yeah, namely the labor market and the broader economic slowdown. Because I was looking through the employment data in our research stack, and the July jobs report is just bizarre.
It really is a strange one.
Right. The consensus projected a gain of 83,000 jobs. Instead, employers unexpectedly cut 23,000 jobs.
A huge miss.
A massive miss. And ADP's private sector backed up that weakness. It showed only 44,000 new workers, and almost all of that was isolated in just healthcare.
Yeah, very concentrated.
But here's the part that makes literally zero sense to me.
Uh-huh.
The report also notes the overall unemployment rate declined. So how can the economy lose tens of thousands of jobs, but unemployment actually goes down? Can you explain that mechanism?
Yeah, I mean, it sounds like a math error, right?
Totally.
But it comes down to how the government actually defines unemployment. To be counted as unemployed, you have to be actively looking for a job.
Okay.
Think of the labor market like a massive game of musical chairs. Usually, when you take chairs away, which represents job cuts, more people are left standing.
Right.
But if a large chunk of the people standing simply get frustrated, give up, and walk out of the room entirely, the percentage of people still playing the game who don't have a chair actually goes down.
Oh, wow. Right.
Yeah. That is called the labor force participation rate shrinking. People are just exiting the labor pool entirely.
So it's not a sign of economic strength at all. It's a sign that people are just tapping out.
Exactly.
That means policymakers are essentially flying blind in a labor market that is throwing off like totally contradictory signals.
They are flying completely blind. And when you combine that blurry labor picture with the broader economic output data, the trend gets even more concerning. Our sources show Q2 GDP slowed down to just 1.5%.
Just 1.5%. So what is the underlying mechanism dragging that growth down?
Well, the reports attribute the growth miss largely to two factors. First, a decline in federal spending. And second, massive corporate inventory drawdowns.
Inventory drawdowns, meaning what exactly?
It means businesses are choosing to sell the stock they already have sitting in their warehouses rather than ordering new goods from factories.
Oh, I see.
Yeah. When you clear out your White House instead of restocking it, it signals a deep lack of confidence in near-term consumer demand. I mean, you don't buy new inventory if you don't think you can sell it.
Right. But if the private sector is pulling back on inventory, what is happening with the public sector? Because the research highlights a staggering headwind there, which is the budget deficit.
Oh, the deficit is huge.
It has surged to nearly $1.8 trillion over the last 10 months.
Yeah.
That is the highest level of cumulative red ink we've seen since March 2021. So the government is spending massive amounts of money, yet growth is still slowing to 1.5%.
Which points to a severe structural drag. And the international reports in our stack show this isn't just a domestic slowdown either. No, China's factory activity unexpectedly contracted in July.
Really?
Yeah, their Q2 export surge is unraveling rapidly due to weakening global demand, which, by the way, was recently exacerbated by some severe typhoon disruptions.
Oh, wow.
And meanwhile, over in Europe, they are dealing with a literal physical logistics nightmare.
I read about this. The riverbeds, right?
Yes. Severe droughts have lowered water levels so drastically that nations are having to physically dredge the riverbeds of the Rhine and the Danube.
Just to keep the supply chains moving.
Just to move things. When a river runs that low, a massive freight barge either can't pass at all, or it has to run at a fraction of its normal weight capacity so it doesn't scrape the bottom. So that means you need 3 barges to move the cargo that usually takes 1. It dramatically increases the cost and the time required to move energy and freight across the European continent.
Okay, so let's summarize the landscape you just painted here. You have an economy growing at a sluggish 1.5%, contradictory labor data, European supply chains physically drying up, contracting Chinese factories, a $1.8 trillion deficit, and a central bank that still wants to hike rates because of underlying commodity inflation.
Sounds pretty bleak when you list it all out.
It does. I mean, a rational person might assume investors are just running for the exits right now. But according to our market analysis, institutional money isn't leaving the market at all. It is just relocating.
Capital rarely just evaporates, and it seeks shelter.
Right.
When the macroeconomic weather gets this stormy, the smart money abandons the speculative, high-growth stories and demands tangible, immediate value. You want a business that generates actual cash today, not one that promises a massive payoff a decade from now.
And this brings us right back to that Coca-Cola paradox I mentioned at the start of the deep dive.
Yep.
The data here is staggering. Coke is up 26% year to date.
Huge.
It just hit an all-time high. And it is actively outperforming every single one of the magnificent 7 tech stocks.
Which is crazy to think about.
They posted 7% revenue growth, 60% earnings per share growth, and they just extended their dividend increase streak to 64 consecutive years.
Amazing.
Boring is officially the new exciting. We are living in a market where sugar water is beating silicon.
I mean, the visual of sugar water beating silicon is funny, but the institutional logic driving it is ironclad.
How so?
Think about the jargon you hear on Wall Street regarding high multiple tech stocks.
Okay.
A high multiple simply means investors are willing to pay a massive premium, say $50 or $60 today, just to get access to $1 of a company's future earnings.
Because they believe that company will grow exponentially.
Exactly. But when capital gets expensive, investors stop paying that premium. They want the $1 today.
Right.
Coca-Cola has reliably increased its cash payout to shareholders through recessions, wars, and pandemics for over 6 decades. In a murky environment, that predictability is just a magnet for capital.
But the research shows it's not just consumer staples seeing this rotation, right? Like, even within the tech sector, capital is being aggressively reallocated based on those very same principles of value.
That is a crucial distinction. The smart money isn't abandoning technology entirely. They are abandoning speculative tech.
Okay.
Look at the regulatory filings in our stack regarding Berkshire Hathaway.
Oh, Greg Abel's moves.
Yeah, Greg Abel executed $4.2 billion in Q2 buybacks, but more significantly, Berkshire deployed over $20 billion into Alphabet.
Okay, wait. Alphabet is a massive tech monopoly. How does throwing $20 billion at Google fit into a defensive flight to safety?
It comes down to the price tag. Alphabet is currently trading at a very reasonable 17 times earnings while still delivering 24% year-over-year revenue growth.
That is pretty solid.
Right. They have an undeniable, highly defensible moat in search and cloud computing, and they aren't priced like a speculative startup.
Got it.
What this signals to you as an investor is that institutional confidence has bifurcated. The smart money demands either bulletproof dividends like Coke or highly defensible, reasonably valued tech like Alphabet. The era of paying 60 times earnings for a company, just hoping that AI fairy dust will eventually justify the price, that is completely over.
That makes perfect sense. It's about buying predictability at a fair price.
Exactly.
But as I read further into our sources on the tech sector, there's another massive layer to this rotation. Capital flows aren't just being redirected by valuations and earnings reports. They're being forcefully redirected by geopolitical battle lines.
Oh, absolutely.
It seems like it is no longer just about what a tech company makes. It's entirely about where they physically manufacture it.
This is the rewiring of the global supply chain happening in real time. Geopolitics is now just as important to a stock's performance as its balance sheet.
And the clearest example of this in our research is the semiconductor memory race.
Yes.
The data shows Micron has shipped over $1 billion in HBM4 revenue.
Huge milestone.
And for context, HBM4 is high bandwidth memory, essentially the multi-lane, high-speed data highway that AI processors desperately need to function.
Right.
And Micron is ramping up production of this new memory twice as fast as the previous generation, which is a direct existential threat to SK Hynix. And they're the South Korean company that has historically dominated this space.
It's a massive technological leap for Micron. They are actively out-innovating the incumbent.
Right. So if Micron is fundamentally beating them on speed and technology, why do our sources show SK Hynix stock jumping roughly 4% on the exact same day this news broke?
It seems counterintuitive, right?
Totally. What is the mechanism there?
It is entirely driven by international trade policy. The underlying fundamentals of the memory chip race are being actively overridden by Washington. The policy briefings in our stack show the Trump administration is pushing an aggressive framework that heavily prefers allied country chip sourcing over Chinese sourcing.
Okay.
In this geopolitical framework, South Korea, where SK Hynix is based, is considered a preferred allied nation. Furthermore, the reports note the White House is actively opposing Apple from sourcing its memory chips from China.
Wow, so even if a Chinese supplier had a cheaper or like functionally comparable memory chip, Apple is being heavily pressured by the government to buy from an allied nation instead,
Precisely.
which artificially props up demand for SK Hynix.
Exactly. That is the mechanism of friendshoring. The government is completely remaking the supply chain through policy mandates rather than free market competition. And the ultimate beneficiary of this heavily protected Allied-focused environment is Taiwan Semiconductor, or TSMC.
The sources highlight TSMC quite a bit. Walk me through why they are so insulated here.
Well, to understand TSMC, you have to understand what a foundry is.
Okay.
They don't actually design the chips. They are essentially the contract kitchen that cooks the recipes designed by Apple, NVIDIA, and AMD.
That's a great analogy.
Building one of these cutting-edge kitchens takes tens of billions of dollars and years of precision engineering. TSMC has achieved a stunning 73% foundry market share.
73%.
Yeah. Essentially, 3/4 of the advanced chip world has to eat at their restaurant.
And despite that monopoly-like grip, the data shows they're only trading at about 25 times forward earnings.
Which goes right back to our valuation discussion. It is highly defensible tech at a reasonable price.
Yeah.
Plus, because they are an allied shore monopoly, the reports note TSMC is already planning AI chip price hikes. And they can enforce those hikes because, frankly, their customers have nowhere else to go.
Wow. And this wave of protectionism isn't just isolated to silicon, right?
No, not at all.
The policy briefs also dive into the pharmaceutical supply chain. The administration has announced planned generic drug tariffs starting in 2028. And the stated goal here is to delay overseas testing and forcefully onshore U.S. pharmaceutical production.
And we should definitely note how the international community is reacting to that.
Yeah, how are they taking it?
The research highlights that U.S. trade partners are actively rebuking the administration. They are specifically pushing back on the forced labor justifications being used to implement these new global tariffs.
Interesting.
It is a highly contentious geopolitical standoff, though crucially the sources note that these trade partners still remain at the negotiating table.
So whether you are talking about the memory chips in your smartphone or the generic drugs in your medicine cabinet, government policy is basically forcing capital to stay within friendly borders.
That's exactly what's happening.
Which brings us back to the daily ticker tape. Now, we don't have the broad top gainer and loser data from the exchanges for today's session, but the themes we've uncovered in these sources tell a remarkably clear story for anyone managing a portfolio right now.
They absolutely do. If you look at the momentum, the market has basically bifurcated into two distinct camps.
Okay, lay them out.
On one side, you have the semiconductor, space, Micron, SK Hynix, TSMC. They are riding a massive dual-engine wave.
Right.
They have insatiable AI demand underneath them and a highly favorable protectionist trade policy insulating them from global competition.
And the other camp?
The other camp is the flight to value, symbolized perfectly by Coca-Cola's breakout.
Right, the sugar water.
Exactly. When macroeconomic data gets this contradictory, when growth slows while inflation risks remain, institutional capital abandons the fairy dust. They flock to companies that can reliably generate cash, regardless of what the Fed does next or who is sitting in the Oval Office.
We have covered an immense amount of ground today, pulling from a massive stack of data. We went from flat inflation data hiding a Chinese import riptide to the musical chairs of a paradoxical labor market, to Coke dethroning the Mag 7, and finally the geopolitics of semiconductors.
It's a lot to process.
It is. So can you synthesize these sources into the core themes the listener needs to remember? Give us the 5 big takeaways here.
Absolutely. If you take nothing else away from this deep dive, remember these 5 themes reshaping the market.
Number 1.
Number 1, inflation remains the Fed's central nightmare. Despite calm headline data, it is being fueled by 18-year high Chinese import prices and the massive physical raw material costs of the AI infrastructure build-out.
Got it.
Number 2, the labor market is flashing very mixed, slightly soft signals. We have shrinking participation rates wrapped in ambiguity, sitting right alongside a sluggish 1.5% GDP growth rate.
Which confirms the Fed is navigating in the fog.
Exactly, they're flying blind. Number 3, sector rotation is actively dethroning the Magnificent Seven.
Right.
Capital is demanding value, predictable dividends, and reasonable valuations, which is exactly what we saw with Berkshire Hathaway's move into Alphabet.
Yep.
Number 4, geopolitics and aggressive trade policies are completely rewiring global supply chains. Friendshoring is forcing massive realignments in both the tech and pharmaceutical
And
sectors.
the final takeaway?
Number 5 is the realization that the AI build-out is a double-edged sword. It is driving incredible corporate growth for the chip makers, but simultaneously, it is acting as a severe inflationary pressure on commodities and infrastructure.
It really provides such a clear lens on why the market feels so turbulent right now.
It does. But I want to leave you with a final thought on that fifth point, because it is the ultimate irony of this economic cycle.
Oh, I like ironies. Let's hear it.
AI was sold to Wall Street as the ultimate deflationary force. It was supposed to streamline operations and make everything cheaper.
Right, that was the whole pitch.
Yet, right now, the sheer capital-intensive brute force required to physically build the data centers and the power grids to run those models is actually causing the very near-term inflation the Fed is desperately trying to fight.
Wow.
So it raises a fascinating question for you to consider. Will the technological cure for economic inefficiency actually go down in history as the primary cause of inflation this year?
That is definitely something to chew on. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.